inventory problem, but it's not what you might think.
That's right. The retail chain says they actually have too much stuff and are being forced to take some pretty drastic measures to get rid of it. Linda Schmidt walks us through the conundrum.
Target is canceling orders from suppliers and cutting prices on certain items in an effort to clear out its bloated inventory. During the pandemic, consumers spent more money on big TVs and kitchen appliances because they were cooking more at home. But now, buying habits have changed.
No one knew how long the shift to those other items that they stocked up on would last. So obviously, they expected that the demand for the things they stocked up on would be longer.
Richard Kestenbaum is an expert in consumer products and retail. He says soaring gas prices and inflation are also playing a role.
It's probably also true that economic anxiety is a factor. That's what we've seen before when economic times become uncertain.
He says consumers are now focusing more on groceries and makeup products.
They can't take a vacation, so they may buy a new scarf or new makeup. We're also seeing consumers go out in ways that they haven't been going out for years now.
I probably am buying things that allow me to go out in public, like lipsticks and things.
More lipsticks, because now we don't need the mask as much to cover up.
But now you will be paying more for that makeup and other items that are in demand because it is costing Target more money for labor, transportation, and shipping. Kestenbaum says consumers can expect to see these trends at most major retailers. Linda Schmidt.
On that day, Target heard the message and is now responding. The company says that it's planning several actions in the second quarter, including additional markdowns, getting rid of excess inventory, and canceling orders. They also say that they're going to be looking for the addition of incremental holding capacity near U.S. ports just to allow some flexibility and speed in the portions of the supply chain most affected by all the volatility that we've seen. They're going to be taking pricing action. This means markups to address the impact of unusually high transportation and fuel costs, so you can anticipate costs going up for consumers. And they're going to be working with suppliers to try and shorten distances and lead times. They go on to say that they're doing a lot of other things. The company is planning for continued strength in areas like food and beverage, household essentials, and beauty. Those are the things that they said were doing so well for them before. They're planning more conservatively, though, when it comes to discretionary categories like home. They say that's where the trends changed so rapidly from the beginning of the year. A lot of the things that they'd ordered maybe 12 months out, some of those deliveries were late, and a lot of the product got here after the consumer had moved on. They say they're going to take some aggressive options here, too, working with their vendors to help offset inflationary pressures. That means beating up on the vendors to make sure that they are taking some of the hit on this, too. And they're going to be building some additional capacity in the company's upstream supply chain over the next 2 fiscal years. They're going to add 5 distribution centers. So I guess if the supply chain's not working for you, you figure it out and you build it themselves. The result of all this is that they are lowering their guidance in terms of the operating margins for the second quarter. They say the second quarter operating margin is going to be in the range of around 2%. They told us 3 weeks ago they expected that it would be more like the operating margins they had in the first quarter. That was closer to 5%. So that is a hit on the operating margins for the second quarter. But they say as a result, for the back half of the year, Target now expects an operating margin rate in the range around 6%. That would be better than they've seen in the fall and the years leading up to the pandemic. They say they continue to look for full-year revenue growth in the low to mid-single-digit range, and they're expecting to maintain or make some market share gains in 2022. I spoke with Brian Cornell about this, the CEO, and he just went on to talk about the reason this is coming now. They do have a board meeting that starts this afternoon, and then they've got a shareholder meeting tomorrow. So they've been looking around, surveying the retail landscape, seeing what's going on with this, and here's their best guidance for what's happening, and laying out these very aggressive measures to catch up with what they admitted was a big mistake in terms of the inventory. They've been looking at inventory levels from other retailers, too. They come in around 30 to 40% across the industry, and if you listen to NPD Group, it will tell you that these are historically high levels of inventory. Target taking some pretty extreme measures here. Brian Cornell just saying that they are doing this. They are going to be working aggressively with this. They want to make sure they're still prioritizing their team because he says that was one of their best assets all the way through the pandemic. So they're not going to be taking cuts on staff members or pay that they're giving to the staff. But just about everybody else is going to be paying a little more, from the vendors to probably consumers, too.